Have you ever looked at your mortgage payment and wondered, wait a minute, why is my payment so much higher than just the loan amount? If you've ever asked that question, you are definitely not alone. One of the biggest things that confuses home buyers is something called an escrow account. I've had buyers call me after closing and say, Sarah, my payment is higher than I expected. So today I'm going to break it down in plain English. By the end of this video, you'll understand exactly what an escrow account is, why most lenders require one, and why it actually makes life easier for most homeowners. And if you're thinking about buying a home, whether you're here in Colorado or somewhere else in the country, there's a link below this video, and my team and I work with trusted lenders and real estate professionals across all 50 states. So if you have questions about getting pre-approved or buying a home, we'd love to help. So let's jump in. Your mortgage payment is not just your mortgage. One thing that surprises almost every first-time home buyer is that your monthly mortgage payment is not just about paying back your loan. It's actually made up of several different pieces. So first, you're going to have your principal, and that's a portion that pays down the amount that you borrowed. Second is your interest. That is what you are paying the lender for borrowing the money. And if you have a fixed rate mortgage, your interest rate stays the same for the life of the loan. What changes over time is how much of your payment goes towards principal versus interest. And then you have property taxes. Those are collected by your local county or municipality. Finally, you have your homeowner's insurance. And that's a policy that protects your home if something unexpected happens, like fire, windstorm, hail damage, or another covered event. And you need to look at your plan to see exactly what it covers and how much of a deposit that you're required if that incident does happen. If you have a mortgage, your lender is almost always going to require you to carry homeowner's insurance because they have a financial interest in protecting the property too. So what exactly is an escrow account? The easiest way to think about an escrow account is this. It's basically a savings account that your lender manages for you. Instead of expecting you to come up with a huge property tax bill once or twice a year and another large homeowner's insurance bill every year, they simply divide those costs into monthly payments. So let's use an easy example. Imagine that your annual property taxes are $3,600. So instead of getting hit with a $3,600 bill or two $1,800 bills, you simply pay about $300 each month into your escrow account. And the same thing happens with your homeowner's insurance. Instead of writing one big check every year, you're gradually setting that money aside every month. Then when those bills come due, your lender pays them on your behalf using the money that's been building up in your escrow account. So most people actually appreciate this because it makes budgeting much easier. Instead of worrying about large surprise bills throughout the year, everything is built into one predictable monthly payment. So do you have to open the escrow account yourself? No, this is another area where buyers sometimes get confused. You don't go to the bank and open a special account. You don't manage it. You don't transfer money into it whenever you feel like it. Your lender handles the entire process. The escrow account is created during your loan process, and your monthly payment automatically includes the amount needed for taxes and insurance. From your perspective, you simply make one mortgage payment each month. Behind the scenes, your lender keeps track of the escrow account and pays your property taxes and homeowner's insurance when they are due. And that's really all you have to do. In the next section, I'm going to explain something that surprises a lot of buyers, the escrow cushion. And it's one of the most misunderstood parts of closing costs. And once you understand why it exists, it will make a lot more sense when you review your closing disclosure. So why do you have to put money into escrow at closing? Here's the part that catches a lot of buyers off guard. When you are reviewing your closing disclosure, you might see something called an initial escrow deposit or initial escrow payment. A lot of people ask me, Sarah, am I paying extra fees here? And the answer is no. That money is still your money. It's simply being set aside so your lender has enough funds available when your first property tax bill or homeowner's insurance bill comes due. Think of it this way. Let's say you close on your house in June. Your county might send the next property tax bill in January. If you've only been making escrow payments for a few months, there would not be enough money saved yet to cover that entire tax bill. That's why lenders collect a little extra at closing. It's simply getting your escrow account started. Now, what is the escrow cushion? This is another thing that confuses buyers. Your lender does not just collect exactly enough money to pay your taxes and insurance. They also keep a small cushion in the account. So typically that's about 2 months worth of escrow payments, although it can vary depending on your loan. And why is this? Because taxes and homeowners insurance are not fixed forever. Property taxes can increase, insurance premiums can increase, and if that happens, your lender still needs enough money in the account to make those payments on time. That cushion helps prevent your escrow account from going negative. And again, that money still belongs to you. It's simply sitting there to protect against unexpected increases. Now, another question I hear a lot is what happens if you sell or refinance? Do I lose the money that's sitting in escrow? The answer is no. If you sell your home or refinance your mortgage, whatever money remains in your escrow account is refunded back to you. And it's not a fee. It isn't money your lender keeps. It is your money. So why do you pay homeowners insurance up front? This part can feel confusing at first. Most buyers pay their first year of homeowners insurance at closing. Then they immediately start making monthly escrow payments for next year's insurance. And people naturally ask, why am I paying for insurance again if I already paid for the first year? And here's why. The policy you purchase at closing covers your first year in the home. As you're living there during that first year, your monthly escrow payments are slowly saving up for the renewal that's due the following year. So by the time your insurance renews, the money is already sitting there waiting to pay the bill. You don't have to come up with another large lump sum. Now, with property tax prorations, here's something that most buyers never even realized happened during closing. So let's say you buy a home in June. The seller owned the home from January through May. Should you have to pay property taxes for the months they owned the home? Of course you don't. And that's where something called property tax prorations comes in. The title company calculates exactly how much of that year's taxes belong to the seller and how much belongs to you. The seller gives you a credit for the portion they owed while they owned the property, and it's all handled behind the scenes on your closing disclosure. So you don't have to calculate anything yourself. Before we move on, one thing I always tell my buyers is this: don't let all these moving pieces overwhelm you. Escrow sounds complicated the first time you hear about it, but once you've gone through the process, it actually becomes one of the easiest parts of homeownership because your lender handles almost everything for you. Now in this next section, I'm going to cover the pros and cons of having an escrow account, explain what an escrow shortage really means, and answer one of the biggest questions I get. Can you get rid of your escrow account altogether? Now let's talk about the pros and cons of having an escrow account. Overall, I actually think escrow is a great tool for most homeowners, especially if this is your first home. Instead of trying to remember when your property taxes are due or setting aside money for your homeowner's insurance every year, everything is rolled into one monthly payment, and your lender takes care of paying those bills for you. So that means you don't have to worry about missing a tax payment, accidentally letting your insurance lapse, or coming up with several $1,000s all at once. For most people, that's a huge advantage. But what is an escrow shortage? Now, this is where people sometimes get frustrated. Let's say your lender estimated that your property taxes would be $3,000 this year. So they've been collecting enough money each month based on that estimate. But then your county reassesses your property or tax rate change, and your actual tax bill comes in at $3,600. So now there's a $600 shortage in your escrow account. Now that shortage has to be paid because those are still your property taxes, and it isn't a new fee. It is not your lender charging extra money. It is simply the difference between what was estimated and what the actual bill ended up being. Now I've had clients call me worried that something was wrong with their mortgage, but once we look at the escrow analysis together, it's almost always because of property taxes or homeowners insurance that have increased. Now, can your payment change? Here's something that's important to understand. If you have a fixed rate mortgage, your principal and interest payments stay exactly the same. Those do not change. The parts that can change are property taxes, homeowners insurance, mortgage insurance if applicable. So if your monthly payment increases, it's usually because one of those items increased, not because your lender raised your interest rate. And that's a really common misconception. Now, what if there's extra money? The opposite can happen too. Sometimes your lender collects more than was actually needed. Maybe your insurance premium went down. Maybe your property taxes were lower than expected. And if there's too much money sitting in your escrow account beyond what's legally allowed, your lender sends that money back to you. And that's called an escrow surplus. Again, it is your money. Now, can you get rid of escrow? Sometimes. If you have a conventional loan and enough equity in your home, typically at least 20%, some lenders will allow you to remove your escrow account. That means you would be responsible for paying your own property taxes and homeowners insurance directly. Now, some homeowners prefer that because they like having full control of their money, but others would rather let the lender handle everything. And neither option is necessarily right or wrong. It really comes down to your budgeting style. Personally, I have found that many first-time buyers appreciate the convenience of escrow because it removes one more thing they have to keep track of. After helping buyers through this process, this is usually what I recommend. Don't focus so much on whether you have an escrow account. Focus on understanding why your monthly payment is what it is. When you know exactly what you're paying for each month, there are far fewer surprises after closing. And if you've ever received an escrow analysis that does not make sense, do not panic. Call your lender, call your real estate agent. Buying a home comes with a lot of moving parts, and escrow is just one of them. But once you understand how it works, it's actually pretty simple. If you're thinking about buying a home, whether you're here in Colorado or anywhere else in the country, I'd love to help. Click that link below. My team and I work with trusted lenders and real estate professionals in all 50 states. So whether you need to get pre-approved, compare loan options, or you're just trying to figure out where to start, we are here to help. And if this video made escrow finally make sense, I'd really appreciate it if you would like this video, subscribe to the channel, and share it with somebody who's getting ready to buy their first home. And I'll see you in the next video.
I can put you in a house on a hill, put you in a condo in the city, put you in a mansion, put you in a mansion in Miami, put you in a mansion in Beverly Hills. Put you in a mansion. I can put you in a mansion.